This is Brian Decker with part 2 of having 6 key parts to a final retirement plan. We talked about part 1, 2, and 3 last time. Part 1 is to have a plan. Part 2 is tax minimization. And then part 3 is risk reduction. So this is new information, risk reduction. There's 3 key parts to risk reduction. One is to get rid of bond funds in your plan which have interest rate risk. None of our clients have interest rate risk because they don't have bond funds. Bond funds lose money as interest rates go up. That's not where safe money goes, like bankers and brokers have told you. Bond funds, in the last 4 years at least, have lost over 30%. And so that is just a killer in retirement. So number one, for risk minimization is to eliminate interest rate risk by not using bond funds. Second, we bring your risk down quantitatively by having much less money at risk. A 60-40 portfolio in retirement, we believe, is insane. Bankers and brokers will tell you to put 60% in the market, 40% in bond funds, and we think that's just absolutely insane. We have exposure to stocks or risk at about 25-30%. So we quantitatively shrink your risk, and then we strategically lower your risk by using momentum strategies that are able to make money when markets go up. We have 5 different momentum strategies as markets go up, cherry picking the best parts of the market, and then different 5 momentum strategies as markets go down. In a down market like 2000, 01, and 02, the S&P was down 50%, NASDAQ was down 70%. During that period, many stocks were going higher, like real estate through the REITs, gold, silver, energy, pharmaceuticals, biotech, and healthcare. All went up during those 3 years. And then when the markets bottomed in March of 03, what exploded to the upside for 4.5 years was technology, semiconductors, small caps, and emerging markets. Then rolling into 08, momentum strategies stop you into cash since nothing was going up except for treasury bonds. Treasury bonds were up over 20% that year. So that is strategically how we lower your risk, by having an offense and a defense, a two-sided strategy in what we believe is going to be a flat market cycle for the next 10 to 15 years. That means that in the next 10 to 15 years, passive buy and hold investment strategies will yield zero because we hit a key point in November of 2021. Whenever the markets trade above 30 times trailing earnings, every time the markets have had 10 to 15 year stretches where they've yielded zero return for buy and hold stretches. So this is Brian Decker. I just want to give a part 3 for the 6 key points of a final retirement plan. I'll do that in the next version.